Hey everyone, welcome back to Corporate Decoder, the place where we peek behind the curtain of corporate filings, and today we're looking at Edible Garden AG Incorporated. Get ready, because this filing might have you questioning what fresh really means. Let's dive into a situation where a company is laying out its future plans. But with a healthy dose of caution, Edible Garden AG Incorporated is putting together a registration statement to sell shares, primarily from existing shareholders. This means the company itself isn't directly raising money from this specific offering, but it is opening the door for others to sell their holdings. The big question is, what does this signal about the company's current standing and its outlook? We're looking at a company that is in the business of controlled environment agriculture. Think of it as farming indoors using technology to grow things like organic herbs. They're using hydroponic and vertical greenhouse systems, basically growing plants without soil and stacking them up to save space. They're talking a lot about sustainability, using less water and energy and avoiding harmful chemicals. They've also got a patented software called Green Thumb that they say helps track plants and manage their operations. It sounds pretty modern and eco-friendly, right? Now this prospectus is all about offering up to 4,043,142 shares of common stock. These shares are mostly issuable upon the exercise of warrants. Warrants are like options that give someone the right to buy shares at a certain price. In this case, the exercise price is $2.06 per S-share, and these warrants are good for 5 years. The selling stockholders are the ones looking to offload these shares, and here is a key point: Edible Garden AG Incorporated itself will not receive any money from the sale of these shares by the selling stockholders. They will, however, pay for the cost of registering these shares. This is where things get interesting. Edible Garden stock is traded on the Nasdaq Capital Market under the ticker symbol EDB. On the 10th of November 2025, the stock closed at $1.44 per share. Now, Nasdaq has a rule requiring listed companies to maintain a minimum bid price of at least $1. The company received a notice in October 2024 that they were no longer meeting this requirement. They had a hearing and were granted an extension to get back into compliance until the 31st of March 2025. The good news is, they did confirm they regained compliance by April 2025, but they will be under a Nasdaq discretionary panel monitor until April 2026. This means they need to be extra careful to keep meeting all the listing rules, because any slip up could lead to delisting. The company is upfront about the risks. They say investing in their securities is speculative and involves a high degree of risk. They point you to their risk factors section, which is pretty standard, but it highlights that potential investors should be prepared for significant unknowns. Now, let's talk about what keeps the lights on, or rather if the lights will stay on. This is where we look at the financial health. A big red flag here is that their auditor has included a going concern explanatory paragraph in their report. This means the auditor has substantial doubt about the company's ability to continue as a going business for the next 12 months. This is not a small detail. It means that based on their current financial situation, there is a real question if the company can survive. And why the going concern doubt? Well, the company admits they have a history of operating losses. They lost about $11.4 million in the 9 months ending the 30th of September 2025, and about $11 million in the full year of 2024. They have an accumulated deficit of over $52 million. Their operations are also using upcash. With $9.1 million used in the first 9 months of 2025, they expect these losses to continue, at least in the near future. Reaching profitability is not guaranteed, and even if they do, sustaining it is another challenge. This ties directly back to that going concern statement. If they can't secure enough financing, shareholders could lose their entire investment. Let's look at the share structure as of the 10th of November 2025. There were 5,126,655 shares of common stock outstanding. Now this offering is for up to 404,342 shares issuable upon warrant exercise. If all those warrants are exercised and the shares are sold, it would represent a massive chunk, about 79%. Of the currently outstanding shares. That is a huge amount of potential shares flooding the market. The primary seller here is Armistice Capital, LLC. They hold a significant number of shares and are set to offer a large portion of them. Importantly, they have a beneficial ownership limitation, meaning they can't own more than 4.99% of the company's stock at any given time to avoid triggering certain disclosure requirements. This limitation means they might not be able to exercise all their warrants or sell all their shares if it would put them over that threshold. When they talk about selling, they're giving the selling stockholders a lot of flexibility. They can sell on stock exchanges, through brokers in private transactions, or even through short sales or hedging. This essentially means that a large number of shares could become available for trading over time, which can put downward pressure on the stock price. This is a crucial point to reiterate. Edible Garden AG Incorporated is not making any money from this offering. However, they do mention that if the selling stockholders exercise their warrants for cash, the company will receive gross proceeds of approximately $8.3 million. Those proceeds are earmarked for working capital and general corporate purposes, but here is the catch. The stock was trading at $1.44 on the 10th of November, 2025, while the warrant exercise price is $2.06. If the stock price stays below the exercise price, it is unlikely warrant holders will exercise them for cash. They'd lose money doing so. If they exercise on a cashless basis, meaning they swap some warrant value for shares without paying cash, the company gets even less cash. So that $8.3 million is a potential number, not a guaranteed one. In part 2 of the filing, we get a glimpse of the costs associated with this registration. The SEC registration fee itself is a very small $799. But then you see accounting fees and expenses estimated at $30,000 and legal fees and expenses at $15,000. With printing and miscellaneous costs bringing the total to around $50,000. These are the company's costs to facilitate this offering from the selling stockholders. Here is a look at how the company protects its leaders. Delaware law, which is where this company is incorporated, allows companies to limit the personal liability of directors and officers for certain breaches of duty, but not for things like intentional misconduct or illegal acts. The company's own bylaws require them to indemnify their directors and officers to the maximum extent allowed by law. This means if a director or officer faces a lawsuit related to their work, the company will cover their legal costs and potential judgments with some exceptions. They also have directors and officers' liability insurance. This section covers the company's promises to the SEC they commit to filing updates or post-effective amendments to this registration statement. This is to ensure that the information provided remains current, especially if there are fundamental changes to the offering or the company's situation. Think of it as keeping the CC in the loop as sales are happening. So investors always have the latest relevant information. Finally, we see the signatures of the key people attesting to the accuracy of this filing. James E. Krass, the Chief Executive Officer and President, James E. Krass. Also signed as Principal Executive Officer, Costas de Fowlers as Interim Chief Financial Officer. And several directors including Pamela Donnarumma, Matthew McConnell, and Ryan Rogers. This signature is a declaration that they believe the information presented in this registration statement is true and accurate. So, what is the takeaway here? Edible Garden Ag Incorporated is a company with an interesting business model in controlled agriculture, focused on sustainability and technology. However, the document paints a picture of a company struggling with profitability and facing significant going concern risks, as highlighted by their auditor. They've managed to avoid delisting from NASDAQ for now, but they're still under a watchful eye. This offering allows existing shareholders to sell their shares. But the company itself isn't directly benefiting financially unless warrant holders decide to exercise for cash, which seems unlikely given the current stock price. The large volume of shares being registered could also put pressure on the stock price. It is a complex situation where innovation meets financial reality, and investors need to be very aware of the high risks involved. Alright? That is our deep dive into Edible Garden Ag Incorporated's latest filing. What is your take on their business model versus their financial health? Do you think they can turn things around, or are they heading for trouble? Drop your thoughts in the comments below. If you found this breakdown helpful, please hit that like button and subscribe for more corporate analysis stripped down to the essentials. And don't forget to join our Discord community, linked in the description for even more discussions and insights. Thanks for watching, and we'll see you next time on Corporate Decoder.